Data sharing can enhance credit risk modelling in a variety of different ways. If we look at the way credit scoring to date has worked, it's been based predominantly on the use of historical data. With the advent of sharing of statement information, for example, transactional data, that provides a new and very rich source of data that can be used to enhance the understanding of a customer's income and expenditure. We also take information now on current account behaviour, but it's very summarised information. And from that we can actually infer a customer's affordability, so their income and expenditure and their capacity to afford a new loan or a new credit card. The transactional information that will come to market as a result of open banking will provide access to a much deeper, richer source of information that provides a more comprehensive view of the way you spend your life, how you manage your finances, whether it be committed expenditure or discretionary expenditure, and where you get your income from. That's incredibly valuable in terms of understanding more about your capacity to actually afford certain goods and services. So by merging credit information with statement information, we can provide a whole new fresh insight on a consumer's capacity to consume financial products and services. If you then extend that into areas such as other complementary information, such as the value of your house or the value of your car, that starts to build up, again, a picture of the assets that you have available to you and what value they have. If you then add into that savings information and maybe even your pension, you get a much more rounded view of an individual's financial circumstances and how they can utilise and invest their money more wisely. So I think it really opens up a whole range of new opportunities for organisations to generate greater insight on the back of people's everyday financial behaviour, but to generate new products and services which can benefit consumers and help them manage their finances in a better way and generate benefit for them as part of their everyday lives, simply by helping get their understanding of what they can actually afford and making an informed judgment on the basis of that. It should also help organisations as well minimise the risk associated with making loans. There's a view that being able to get access to things like transactional data and then being able to match that to credit information, maybe savings data and pensions data, would enable you to get a much better understanding of the risk associated with providing a mortgage to that individual or maybe a credit card. And being able to monitor that behaviour throughout the life of a customer gives you opportunities to both minimise the risk when potentially they go into, they change, their financial habits change and they might go into to debt, but also to look at what opportunities are available in the future in terms of new products and services that they may wish to consume. So, for example, you may have recently had your first child, which has been illustrated in terms of your transactional behaviour in your bank statements. That in itself could provide opportunities to provide new products and services to that customer and also help them think and plan for the future in terms of the investments required to support a family. So it's a great illustration of how transactional data could be used to actually forward plan an individual's spending and financial consumption to improve the quality of their life and make sure that they don't get into debt and that they can plan effectively and manage their lives effectively.